Thank you so much. Hi, I'm Regina Korossy, financial advisor with Edward Jones, and thank you for having me back to the ABCs of HOA's Board Educational Event of 2024. It's always a pleasure to be here with you and share our outlook on the areas we watch closely for our clients as we kick off this new year. So today, I'm going to share our outlook for 2024, what we see happening in the economy with the Fed, with inflation, and of course, what we think about portfolio positioning, as well as some opportunities that you may want to take advantage of. So let's kick things off with what happens with economic growth. So the US economy was quite resilient in 2023. Economic growth was at or above trend levels of 2%. And now in 2024, we expect US economic growth to remain positive, but soften in the first half of the year. Growth rates will likely fall to below 1.5% annualized. Now, why the slowdown in growth? Well, we do believe that somewhat weaker consumption, lower government spending, and a cooler labor market will translate to slower growth. The consumer faces some challenges heading into 2024, and those include declining excess savings and a rising credit card debt. In addition, we believe some loosening in the labor market may put additional downward pressure on wage gains. But on the positive side, a slowdown in growth could potentially support lower inflation and less need for further Federal Reserve tightening. So as we look toward the second half of 2024, we expect the economy to gradually accelerate once again. We believe lower inflation rates, a Fed that is signaling rate cuts, and a better earnings growth will lead to improving economic growth later in the year. And remember, markets are forward-looking. They can start improving and moving higher even before economic growth stabilizes and improves. Does the Federal Reserve cut rates in 2024? Well, at the core of our outlook for the markets is the trajectory of Fed policy. We believe that after the most aggressive tightening campaign in 40 years, the hiking cycle is now complete. So the Fed will likely proceed with caution, perhaps even signaling an extended pause and keeping that Fed funds rate at 5.25% to 5.5% early in the year. But we believe that easing inflation pressures, a cooling labor market, and a slowdown in growth will likely pave the way for interest rate cuts in 2024. So in our view, the Fed will likely cut more than the 2 cuts it outlined at the November Federal Open Market Committee meeting, but perhaps less than the 5 to 6 cuts that markets have already priced in. We believe that if the Fed funds rate is at 5.25% to 5.5%, longer-term neutral rates are closer to 2.5% to 3%, and inflation is moderating, then there's less need for the Fed to remain this restrictive. And all this to say, we see a Fed rate cutting cycle emerging in 2024. Can inflation continue to moderate? Well, the trajectory of inflation is another key driver of our outlook in 2024. We've seen progress in 2023 with headline CPI inflation, which measures the cost of living, and that has fallen from a high of 9.1% back in June of 2022 down to 3.2% at the November reading. Core CPI, which excludes food and energy, also continued to slow, falling to 3.2%, which is the lowest reading in 2.5 years. However, core inflation is still above the Fed's target of 2%. Now, looking a lot at consumer spending, we also know that consumer spending rests squarely on the shoulders of the labor market. And the latest employment report showed that the jobs market still remains resilient, with a better than expected 216,000 jobs added in December, holding the unemployment rate steady at a healthy 3.7%. Now, despite last month's increase in hiring, we think the labor market will bend and hopefully not break as we advance, with a slowdown in the pace of job gains and a modest rise in the unemployment rate. This is further corroborated by additional employment data that showed job openings, while still robust, continue to shrink and indicates a cooling in the labor market. This should lead to slower wage growth and therefore slower parts of services inflation. This should also prompt consumers to exercise a little more restraint in consumption than we saw over the last 2 years. So if consumers are not purchasing as much, then that signals to producers to lower prices. This was further confirmed with the PPI, the Producer Price Index, which in contrast to CPI came in below expectations and unexpectedly declined 0.1% from the prior month. Now, PPI measures the average change over time in the selling prices received by domestic producers for their output. The downside pressure in wholesale prices should also help lower the consumer price inflation. Now, the figure that we are paying most attention to is wage growth, as this sits squarely at the nexus between consumer spending and inflation. As odd a thing as it might seem to root for, moderating wage gains are, in our opinion, a necessary component of inflation returning to a more comfortable and sustainable rate. So if workers are not seeing an increase in wages, then they should spend less. Wage growth ticked higher in December, but a broad-based assessment of employment conditions suggests to us that wage growth will moderate further this year, but it could also remain in the sweet spot where it relieves inflation pressure while also supporting spending. Additionally, consumer inflation expectations, which feed into actual inflation, are also moving lower. So looking closer at shelter and rent components of inflation, which make up nearly 40% of the basket, we see that they have softened after their 2022 spike. These are typically lagging indicators that show up several quarters later in CPI figures. Some additional factors that we follow include energy prices, which remain volatile and are affected by geopolitical uncertainty, which is certainly elevated right now. But crude oil prices are around $73 a barrel, which is near the low end of their 2-year range, as are gasoline prices. Used car prices have further to fall, as suggested by the wholesale auction market. And we also look at the cost of car insurance, which has surged 20% compared to a year ago, which is the most since 1976. So all this to say that we believe that the downward trend in inflation that began in 2023 continues in 2024, with the last mile down to the Fed's 2% target. It may be gradual, it might even be a little bumpy, but we do see core inflation heading towards 2.5% in 2024. So what does this mean for your portfolio in 2024? After solid returns in 2023, we do see opportunities in both equities and bonds for 2024. Now, keep in mind that bear markets, like the one we saw in 2022, are historically followed by positive returns. In fact, often these periods can last for several years. So when we look back, together with rising corporate profits at the beginning of this year, the Dow reached a fresh record high in the first trading day of the year, and the S&P 500 exceeded its peak as well. Now, historically, it takes about 2 to 3 years after a bear market to reclaim the prior highs. But once stocks exceed the prior peak, they tend to keep rising for another 3 years until the next bear market arrives. If the key theme for stocks in 2023 was narrow leadership with large cap technology, or the so-called Magnificent Seven driving much of the gains, then perhaps we would view 2024 as the year when laggards play some catch-up. So looking back at 2023, US large cap technology stocks led the sizable gains in the equity market for most of the year. However, since November, that sector has lost some of its powerful momentum as other cyclical and defensive stocks that have lagged and are sensitive to interest rate cuts started to look more attractive. We expect this sector rotation to continue and likely pick up steam in the back half of the year as economic growth reaccelerates. So we recommend complementing growth investing with some of these lagging assets that include cyclical and value sectors, as well as small cap stocks, which could play some catch up in 2024. Now, with artificial intelligence still in the early innings of multi-year growth, we still view this space favorably. But we do see diversification beyond technology more critical to portfolio returns in 2024, especially as valuations are more favorable outside of these areas as well. Now, before we talk about bonds, let's take a minute to acknowledge that as of December, there was over $6 trillion in money market and nearly $25 trillion in cash equivalent assets like CDs and treasuries. So let me put that into perspective. The entire US market is just over $46 trillion. So that means that more than half of the entire US equity market was sitting in cash. Since these cash instruments can experience what is called reinvestment risk, when rates come down, as these CDs come due, CDs and money market will become less attractive. And as the stock market continues on its upward trending line, you may miss out on the better prices of stocks and bonds. So if you have too much in cash for your own financial goals, then the majority of your nest egg is barely keeping pace with inflation. So we do recommend complementing your cash-like investments, including CDs, money market funds, with longer-term investment-grade bonds. These bonds can help you lock in these historically high yields for a longer period, and they may also appreciate as the Fed begins cutting interest rates. So as we look ahead to the next 12 months, we expect 2024 to be a positive year in the markets. But like any other year, it will have its share of volatility, which means you can use this volatility to your advantage. We believe balance and diversification in your stock portfolio and bond portfolio can help you position to maximize return potential for the year. We also recommend meeting with your financial advisor to ensure you have the appropriate exposure in your stocks and bonds, and that your portfolio is tailored to your specific financial goals and risk tolerance. Now, since this is also an election year, I'm often asked about how elections affect volatility in the markets. While political headlines could drive short-term volatility, history shows that markets have actually performed well in election years, with the average returns between 3.3 and 13.6%, and median returns as high as 16.8%. In fact, remember that the financial markets have shown great resilience over many, many decades through not only presidential elections, but also through wars, recessions, natural disasters, political crises, and other dramatic events. As we see here, the stock market has recovered 100% of the time. So I often remind my clients that the market only moves in two directions, up and down. And some of the largest up days in the stock market are often occur within close proximity to the largest down days. So that's why we often say that it's not about timing the market, but about time in the market that makes the difference long term. At the end of the day, you can use market volatility to your advantage to rebalance, diversify, and add quality investments at better prices, ultimately to meet or exceed your long-term financial goals. In addition to taking advantage of market volatility to rebalance and diversify, we also want to take advantage of some saving opportunities that exist in 2024. For example, contribution limits have gone up for retirement plans. So whether you're contributing to an employer plan or saving on your own, now is a really great time to revisit your budget and see if increasing your retirement savings contributions is possible. So you can take advantage of these increased limits. So starting in 2023, SEP and Simple plans can now accept Roth contributions. And beginning this year, participants can contribute 110% of the normal contribution limits, including catch-up contributions. Also beginning this year, employer plans can make employer matches for qualified student loan payments. And remember that you can still make an IRA contribution for 2023 right up until you file your taxes for that year. You can also front load your 2024 contributions into an IRA. So you can take advantage of 12 months of compounding and growth instead of waiting to do it at the end of the year. It's always more productive to focus on those things we can control instead of the things that we cannot. And these are all great ways to be working towards achieving your long-term financial goals. We believe that 2024 is going to bring lower inflation, renewed expansion, and a positive year for both stock and bond returns. And we look forward to the opportunities ahead.